I believe we're starting to see a pretty significant shift within the investor. We're watching those high flyers start to slow down here, pull back, and consolidate, but we're also starting to see a bid under deeply valued stocks that pay dividends. And it's been my thesis on this channel to lean a little bit more defensive lately, because I do think 2025 and 2026 could be some hard times ahead. When we think about the fiscal spending that's taking place, I do think this is going to be a problem going forward, and I think the majority of market returns could actually come in the form of dividends and not capital appreciation, and therefore I've been leaning more defensive, low valuation, with companies that have resilient earnings and do pay dividends. That's not the only thing I'm looking at, but it is where I'm keeping my mind focused. And so a lot of people have been talking about this $6 trillion that's sitting on the sidelines waiting to come in and keep this bull market ignited. Now, personally, I don't think that $6 trillion that's in money markets is the type of money that's going to come in and fly into high-flying stocks. When yields come back down, that type of money is probably going to go in your defensive sectors that do pay dividends, because that money is trying to achieve something. It's trying to achieve low beta and it's trying to achieve a yield. And once there is no other assets, once yields come crashing down, I tend to think that that money is going to find a home in higher paying dividend stocks with low valuations and low beta. And those stocks have been tremendously discounted as of late, but we're starting to see them ignite. I'm talking about companies like AT&T, Verizon. Verizon hit a low of nearly $30 a share and was paying over an 8% dividend at those levels. And now it's trading for over $41 a share. And there's more stocks out there that are doing that. As most of you know, I was a big bull on Pfizer at $25 and $26. Now Pfizer's starting to knock on the door of $30 a share. So what I want to do in this video is go over my portfolio, where my mind is, and what other stocks am I personally looking at picking up at these levels. So let's get into it. And by the way, if you're new to the channel, welcome in. We take a fundamental approach on this channel, and we do not recommend buying individual stocks. This is my personal journey. This is my risk. It is very time consuming to pick individual stocks, and 9 times out of 10 you're going to fail. So the time that you're putting into individual stocks probably makes more sense to actually work extra hours and invest that money in a passive, diversified ETF and or mutual fund. I'm going to go over exactly what I'm seeing and opportunities that are presenting themselves. As you guys can see here, by market value, Pfizer is by far my largest position, making up 29% of my portfolio, and shortly following is Cisco Systems, making up roughly 25% of my portfolio. So right off the bat, we see that I'm just starting to build this portfolio, so obviously allocation's going to be a little jacked up here, so bear with me as this is going to be a longer term process. We started this account with $25,000 and I sold out of everything and started from day one, just to show you guys the journey I'm taking here. And I sold out of companies that have absolutely skyrocketed, so that is frustrating, but I tend to think that I have a process that does succeed, so I will be able to find more of these types of companies. You guys can see here when we look at portfolio performance, not including today, that I've been underperforming most indexes except for the Dow Jones. And so I'm basically in line with a lot of the sectors right now, but where I think I start outperforming is when those dividends start paying out and we start seeing investors shift here. As I stated before, I think we're starting to see valuations get a little stretched here, so my focus has been on very low valuation type companies that still have strong fundamentals underneath them and pay pretty substantial dividends. As I stated before, I think majority of returns going forward for an extended period of time could be coming in the form of dividends, as when we look at debt to GDP, we look at valuations, there's a lot of things showing us that it's going to really be hard to outgrow, especially in the tech sector. So I'm really looking for deep value, underperforming assets that I think have tremendous opportunities. Now, I want to open up with Cisco Systems really quick, as the stock is up nearly 2% on the day. This is a company that reported earnings. The stock shot up to $52 a share and then sold down to $46. It was crazy price action, and they did nothing wrong. They're actually achieving exactly what I thought they were achieving, and I think fair market for this company is $43 and below. I did reach a little bit here, but they are doing some interesting things. Now, Cisco Systems forward PE is trading right around 13 times earnings, pays over a 3% dividend. And this is not where the business is interesting. Where the business becomes interesting is the amount of companies that they've recently acquired and implemented into their business. I'm talking about companies like Splunk. So now they're getting that SaaS into their business, which is eventually going to grow margins, and the multiple could be wrong on the stock, meaning that this could be a stock that's trading closer to 17, 18 times earnings once those margins expand, which means that this price right here, I think has an opportunity to outperform. Now, a lot of people were overlooking this company as an AI prospect. Cisco is launching a $1 billion AI investment fund, basically getting a lot of new startups within their branch, funding them and getting them up and running to make more reliable AI products. And this is where the market has been discounting this company and looking at it as just a legacy products type company, and that's just not the case. Now, with the build out of AI, I think there is multiple tailwinds for Cisco here. We're going to need updated products if we're starting to really implement AI through our lives. We'll be implementing Splunk to a lot of their customers and introducing Splunk to a lot of their customers, which then will grow Splunk's top line and in turn grow Cisco's top line and bottom line as margins will expand with this SaaS business in them. Now we factor in the infrastructure. Now we factor in that they're launching a $1 billion AI investment fund to bolster the ecosystem of AI. And this just seems like it's positioned extremely well and you're getting a lot for the money. To me, this is one of the best deals on the stock market, and that's why it started to be built out as one of my larger positions. As I stated before, it's hitting on all cylinders, ladies and gentlemen. I think it's in the right place at the right time. I think it has multiple tailwinds, so earnings could actually still grow here. I think the forward PE is very, very reasonable when we compare it to a market multiple, and it's giving an above average dividend. So this checks the box to me on a lot of different areas. And you get the similar situation, in my opinion, when we look at companies like Pfizer, Bristol Myers Squibb, and a few others out there, but definitely healthcare and consumer staples. Ticker symbol SJM, Smuckers. I've talked about this stock a few different times. We're probably going to be ready to unload a bullet on this one after earnings if they miss earnings and everything looks cohesive with the company. We're waiting for earnings release on Smuckers because, as we saw by Hormel Foods, the response was pretty negative. And I do think they're still dealing with high inflation, and I think they're still trying to figure some things out. But as we go through deflation and possible recession and a consumer slowing down, Smuckers is positioned extremely, extremely well. Once again, what is it hitting on? Low multiple, trading at 11 times forward earnings and a above average dividend rate, which they've been paying that dividend for 20 plus years and raising that dividend for 20 plus years. So Smuckers to me is probably going to be a top 5 holding in my portfolio if we get a substantial pullback on it. Where are we looking to enter in Smuckers? Anywhere between $90 to $100, which means about a 15 to 20% sell-off here would do two things. Number one, it would get us a yield pushing above 4%, which is going to be competitive now with the 10-year Treasury, as the 10-year Treasury has crashed to about 4.4%. So we're basically going to be getting a 10-year Treasury with inflation hedge owning the actual company, and the fact that it's in a defensive sector. So that money that I'm talking about that's going to move from the sidelines from 5% Treasuries could be looking at companies like this. And I do think there's going to be an opportunity to buy this possibly on a dip. Now, this doesn't mean that I'm not taking on any risk here. I have some interesting positions that I think could go in either or direction. The majority of my portfolio is definitely defensive. We're talking about CVS, we're talking about Pfizer, we're talking about Cisco, we're talking about making a big addition into Smuckers. But when I look at Paycom, that is a growth company that's in a financial sector. High risk, high reward. This was a company trading for over $500 a share. The fundamentals still seem intact. Management's all over the place, and there's a lot of fear in the streets. So this is a big risk, big reward type of company. I do think that this company could reapproach that 200, 250 mark once again, which means that there is a lot of upside in here, but not without risk. Dutch Brothers, strong growth. We had 100 shares of Dutch Brothers. We bought in around $28 a share, sold half of our position, right around $36 a share. So we still have 50 shares of Dutch Brothers. This is starting to get pretty expensive, but hyper growth. They're looking to add a tremendous amount of new locations very, very soon. And they seem to be taking market share from companies like Starbucks. So very interesting position. I think it's a little expensive at these valuations. That's why I sold half my position. I'd be willing to take on a higher percentage of a position if it did get back into the high to mid 20s. The new addition that we added in was GPN, Global Payments Inc. Once again, hitting on a few cylinders here, trading for a forward PE of 8 times earnings and a 1% dividend yield. But this was a company trading for over $217 a share and basically got cut in half. I still think that there is some growth opportunities here. Don't love the payment processors, as I do think the margins are getting squeezed as it's getting more and more competitive. But this one seems to be deeply discounted. When we look at sentiment around the stock, we have a price target as low as 105 and as high as 186. I think it's sitting in fair market territory right now. Do I think it can go lower? Absolutely. But I also think it's a good company at a good price. And so that's why we're starting to take a small risk on this one here as well. We're probably not going to add too much more into this position. So to recap really quick, what am I personally looking for? I'm looking for those low multiples, resilient earnings, and higher dividend yields. That's where I think you can hide out in for the next foreseeable future and actually get above average market returns. When we look at this bull run here, I do think there's correction around the corner, and I do think we have some serious problems. But when we think about the type of companies that I'm looking at, a lot of the times those are resilient earnings. And so we look at companies that I'm looking to acquire here. Necessities of life, Bristol Myers Squibb, high dividend yield, going to have a low forward multiple there, especially if they're able to earn that $5 to $6 of earnings, trading at under $41 a share. It seems very reasonable. And then we look at it as Smuckers. If Smuckers comes out and absolutely has a disastrous earnings, be a long-term buying opportunity to add some yield into your portfolio, add a consumer staple in there, something that's not exciting, but nice to have that balance within your portfolio. But I do think the upside could be pretty substantial if we get that big pullback that I think could be coming, as we saw from Hormel Foods. Now, as far as Pfizer goes, if Pfizer starts breaking above $30, I'm probably going to be selling some calls against that position, build some more capital, and maybe even sell out just a little bit here and diversify that out. Also, we're going to be adding more capital into this portfolio soon. We haven't added capital in a substantial amount of time. So where I think I might add capital is if we do get that sell-off in Smuckers, I'll probably add some capital, start averaging into it, and taking my time slowly building into that position. And as always, guys, this is just my opinion, and we will see you in the next one.